Hey everyone, welcome back. Let's quickly break down today's U.S. market action using three key charts: the 10-year Treasury yield, QQQ, and SPY. Today was not about news headlines, it was about rates pressure and intraday positioning. Let's start with the bond market because that's where the move really begins.
On the first chart, we're looking at the 10-year Treasury yield. Right now, TNX is trading around 4.23%, down roughly 0.4% on the day. What's important here is not the size of the drop, but the behavior. We saw an early push higher, followed by a steady pullback, and then stabilization below 4.25%. This tells us that bond buyers stepped in, cooling yields after recent pressure. Lower yields, even slightly lower, tend to relieve stress on equities, especially tech. But today, that relief was limited, and that's key. So while yields eased, risk assets didn't fully respond, which brings us to QQQ.
Now let's look at QQQ, and this chart clearly shows where the pain was. QQQ is down about 1.2% on the day, and the structure is important. Heavy sell-off in the first half of the session, a sharp drop into late morning, then a partial bounce but no full recovery. This is classic distribution behavior. Buyers step in after the drop, but they don't have enough strength to push price back to key levels. Notice how price failed to reclaim prior support. That's a warning sign. Despite yields coming down, tech still stayed weak, which tells us positioning is cautious and traders are reducing exposure rather than buying aggressively. This weakness in QQQ sets the tone for the broader market.
Now to SPY, the broader market. SPY is down roughly 0.7%, and compared to QQQ, it actually held up better. We see the same intraday pattern: early selling, a strong downside move, then a rebound attempt. But again, just like QQQ, the bounce stalled below key intraday resistance. This tells us the market is in defensive mode, not panic selling, but also no conviction buying. SPY is absorbing the sell-off better than tech, which suggests rotation out of growth and into more defensive or value positioning. Still, the market is clearly reactive, not proactive. Putting all three charts together, today looks like rates cooled but didn't collapse, tech stayed under pressure, the broader market held but without strength. This is not a bullish confirmation day. It's more of a pause after recent volatility. The key takeaway: as long as yields stay elevated near 4.2 to 4.3%, equities, especially tech, will struggle to build momentum. Right now, the market is waiting for clearer direction on rates, waiting for stronger buyers to step in. Until that happens, expect choppy price action, fast intraday moves, and limited follow-through. That's it for today's quick market recap. If you're trading short-term, stay nimble. If you're investing, patience is still key here. Thanks for watching, and I'll see you in the next update.